There's a term, I'll always be raising, and I don't think it's that as a CEO. I think it's always be cultivating, so ABC, in that you're looking for affinity and connection with people throughout your journey. It's not that you're, okay, I'm 6 months out and now I'm gonna look for investors. You're finding people each step of the way that you know have an alignment and that you start building a relationship with.
Welcome to Startup Health Now, the podcast where we talk about the entrepreneurs shaping the future of health and the health moonshots they're working to achieve. I'm Logan Plaster, Editor-in-Chief at Startup Health. So COVID-19 has presented a bit of a paradox to economists. Many have written about a K-shaped response to the pandemic, where some parts of the market expand and grow significantly while others contract. We've seen this contrast play out a bit in health innovation, where on one hand, digital health adoption is at historic highs. Telemedicine, remote monitoring, and digital therapeutics are exploding. At the same time, many investors are wary. We've heard stories of investors calling to hold off on wiring funds, of VCs halting new investments, and of angel investors deciding to significantly cut back check size. In other words, despite the obvious need for virtual care in a COVID world, raising money has come with major challenges in 2020. So we decided to bring in two founders from the Startup Health family who had successfully raised millions in the middle of COVID to learn how they handled the bumps in the road. Our guests were Lynda Brown-Ganzert, CEO and founder of Curatio, and Richard Hanbury, CEO and founder of Sana Health. Both joined Startup Health's expert office hours recently to share their insights in a conversation moderated by Katya Hancock, Startup Health's Investor Network Director. We learned a lot from what they went through, and we present the full session to you now. Hope you enjoy.
Well, it's great to be here with everybody today. Looking forward to today's discussion with Richard Hanbury and Lynda Brown-Ganzert from Sana Health and Curatio, respectively. A lot of you are raising capital right now, or planning to in the near future. It's a different landscape, as you all know, than it ever has been. People are not having face-to-face meetings. Everything is remote. People have many, many different things that they're dealing with in their lives in addition to their jobs. And so it's going to be really interesting to have this dialogue today with two health transformers who have closed rounds during the pandemic. And I'll let them introduce themselves and talk a little bit about the rounds that they closed and what kinds of investors, and a little bit about the experience. And we had a prep call yesterday, and there's a lot of lessons learned, a lot to unpack that I think are helpful with or without a pandemic, but also with a pandemic. So feel free to pop your questions in the chat as always. But why don't we kick off with you, Lynda, to introduce yourself and just give a high level kind of overview of your experience, and you can keep it short to start, and then we'll unpack it about raising your round, what it looked like, how it came together, and kind of how the pandemic made it a different experience than normal.
Sure. Okay, great. Hi, everyone. Lovely to be virtually connected. So I'm Lynda. I'm founder and CEO of Curatio, and we closed our pre-Series A or post-seed early June. So we were raising right as the pandemic started, and then as it started to kind of crest, and we all started to realize this is going to be a serious issue. So there are definitely some challenges, and I'm happy to run into them, but there were also some opportunities. And so we had kicked off socializing around the previous fall, and we had one pitch competition, which was really helpful too. And came with a term sheet out of Connecticut, great group, and went hard into the new year, starting in January on a full-on sort of raise. So we're socializing, and in November, December, came back after the holidays and went full bore into it. You guys all know this, right? It's, 101 to 10 to 1 in terms of meetings to kind of connection rate, but lots of meetings, lots of really good momentum, lots of people interested in following and participating but not leading. So we headed into the pandemic with, some really strong soft circles behind us, but not a strong lead. And so we were trying to kind of round that out. And so it was interesting for us, and I can tell you more about how we structured it, but in a matter of days, we went from being a nice to have solution to a need to have. And as we started to grapple with, oh my goodness, how are we going to support outpatients? How are we going to address mental health? How are we going to impact adherence? How do we do, navigation and support for patients at a distance? It started to be apparent that Curatio was a great solution for that. So, the round, we marched very firmly to a deadline. It felt quite critically that in order to really be of best service to the pandemic and the needs, that we needed to get the round closed sooner than later. And some timing considerations. I think had we taken a different approach to timing, we may have had some different options. But it was important to me that we got back to work and back into supporting the pandemic as quickly as possible. And so we had two funds that wanted to partner and come in for the full round. Made it really simple. We really liked the teams. It was a good fit, and that's what we ended up closing at the end of May.
Awesome. There's a lot to unpack there, but I want to give Richard a chance to introduce himself and kind of give your high level as well.
Certainly, thanks. I'm Richard Hanbury, CEO of Silent Health, and just occurring to me that this is expert office ads. I am certainly no expert in this, but I am now. I've got thousands of mistakes to avoid making, because we've done a lot of things wrong and learnt along the way. So we'll try and pass on as many of the most important ones of those as we can. We were doing a rolling close. We were in talks with a big corporate. We were under a no shop clause. That went through the start of COVID into when I was in hospital for open heart surgery. After that, and then 2 days before we were due to close with them, they pulled out. And then 2 days later, I had another completely new lead who allowed us to close a round. So we closed 2 so far, and we're now raising a further 3 because realistically, I think Q4 and into Q1 next year, we're looking at some extremely unpleasant macro situations that are possible, if not likely, to evolve with political upheaval smashing into economic problems, smashing into COVID. So we're out raising more. Lots of lessons learned all the way around. All the things that are sort of more true than standard raising because of COVID. Some of the limitations, but I think there are actually, to Lynda's point, more things that are actually made easier because of COVID than there are overall problems, as long as you are directly addressing people's concerns and using the advantage of COVID and Zoom, which is you can go through meetings and qualify people and have them qualify you more quickly than you could have done before. So that's the high level.
That's great. And Jenny from Helpful, I'm going to ask you to come off mute and ask your question, because I was actually going to go in this direction too. Both Richard and Lynda talked about finding a lead. And that's really something that a lot of founders struggle with is, how can I find a lead? How can I find a lead? Lynda, Jenny, do you want to come off mute and just kind of expand on your question about finding a lead?
Sure, thanks. Yeah, so just you're laying out your map, your journey sounded a lot like our experience, but we haven't closed. We've sort of pulled back actually, and so especially lots of interest to to follow, not to lead. And so just wondering, was part of it just, great serendipity of the relevance of Curatio in the midst of the pandemic, or were there other factors that helped you kind of unearth the leads to close your round?
Yeah, it's a really good question. I think finding a lead is hard, right? Because there's so much work that they have to do, and they're taking the front role, and depends on what else they're working on, their deal flow and such. I think in part that's why we ended up choosing the two groups that we did, because they could move quickly. They made that commitment to us that as a lead, they would move through due dil in 6 weeks, and that they closed on 100% of their term sheets.
Mm.
And I didn't even think to ask that question. I ask a whole bunch of other questions when I'm qualifying a fund or an investor, to see if it's a fit before we take each other's time. But that's a really important question to ask: is what percentage of your term sheets have you closed on, and how long did that take? Because I knew that the faster that we could get back to the work at hand and being of service to people around the world during this pandemic, the more traction we would have in growth. And so it was a bit of a trade-off, because it wasn't necessarily the strongest term sheet, but with that commitment of timing and 100% close, that kind of sealed the deal. But now I know too to look for that kind of lead, right? The kind of lead that wants to lead, prides themselves on closing, is founder friendly and efficient. And so, that was for us. It was looking at who was in front of us, the term sheets we had, and where we think we could move fastest, not necessarily the highest valuation. And that's what was maybe a bit different during a pandemic, because maybe in a different time we would have said, okay, well, let's take the time, work with the highest valuation, but we didn't. We decided to move quickly on it.
Can I just ask a quick follow-on? Do you think without the pandemic, those two would have been stepping up in the way that they did, or was it sort of situational?
So we got to know them before the pandemic. So I knew that they liked the team, they liked the leadership, they liked the solution. So that was all there. But certainly, we had even more interest after we closed, with people not knowing that we had a term sheet, just because of the market need. So I don't know if that answers your question, but it was interesting. I remember Pauline and the Startup Health Gang always talk about marching towards that timeline and setting the timeline, driving the process, and certainly the pandemic helped with that, and setting that date.
Thanks.
We talked about that a bit yesterday, Lynda, about creating, even if it's an artificial deadline, creating urgency, creating scarcity. Do you feel like that helped get those leads to the table, the fact that there was a deadline?
Yeah, absolutely. I mean, we're all human, right? And so we just need to work better towards a deadline. And as entrepreneurs, like, time is our most precious resource, right? As a CEO, your time is the most precious thing, and so you can just be, as you all know, you can be caught up in fundraising for months and months. So I think it's really important, and Startup Health always says this, right? Like, march towards a timeline. Be a buyer, not a seller. Right? Interview who you want to work with. This is as much about what's going to work for your company as it is on what's going to work for the fund.
Absolutely. And that mindset can really shift the conversation. Natalie, why don't you come off mute and ask your question?
Hi, Lynda. Thanks for speaking with us today. Can you guys hear me okay?
Yes.
Yeah.
Okay, great. You mentioned the what was the time frame when you say you asked how many term sheets have you closed on recently? Did you say 6 weeks? Did you give a time frame to that?
So there's two parts to that question that you want to ask. Is the first part is, of the term sheets that you've put out, let's say in the past year or the past quarter, depending on the size of the fund, what percentage have you closed? And then how long does it take you to go through due diligence?
Okay, awesome. Thank you.
Great. So Richard, I want to unpack a couple of things that you talked about. One is simple, which is you mentioned the no shop clause. You agreed to a no shop clause that was too long. You now have a lot of perspective about how long you think it should have been. Can you share your thoughts around that? I think that could be really helpful for folks.
Yeah, I mean, so we signed one that was 90 days, and we thought we were going to be well closed within that time. If your runway is not much more than 90 days, you can't do that. You know, that there is a so just to back up a bit, anybody who doesn't have a specific large benefit from having corporates as a lead, my advice was just don't do it. As if there is a specific, this would completely transform a business in the way that we want to transform it, and we're certain about that, and we have the data that proves that's the right way to do it. That's you know, obviously that's a good way to go. We had a corporate that agreed with what we thought we wanted, but we weren't naive enough to think that we knew the answers, and therefore we were like, unless the data and market feedback says differently. The market data did say differently, and they didn't care. They wanted to do what their objectives were, regardless of what risk that put the company at. So super care on that front. I do think, to Lynda's point about questions, it's important to have your cheat sheet, you know, on your computer screen next to your Zoom ready, so that you don't just get carried away with the process of answering their questions, and that you do drill down into exactly what is going to make sense for you, because that is absolutely going to speed up the overall process. So on the no shop clause, it's like, okay, if someone wants 3 months, why do they want 3 months? Are they actually anticipating that it's going to take them that long? Now looking back, I should have said, okay, 30 days, and we can renew at 30 days, as long as we've made enough progress towards the final goal that we both believe we are going to get there. 90 days just allowed them to be typically corporate in the way they were approaching it.
So can you share any other red flags, hindsight is 2020, that you wish you had paid attention to? I mean, this was obviously a potential investor that wasted a lot of your time, and you fortunately found another lead at the last minute, but could have gone the other way. So anything else that you look back? Yeah. Yeah,
absolutely. So one VC said to me, you never know what a VC is thinking anyway. But generally speaking, as a huge overall generalization, corporates have a ton more political stuff going on behind the scenes than you will ever know. And the VCs, generally speaking, have a much more straightforward motivation of what they're doing and why they're doing it. The first of all is the corporates are a lot trickier situation to deal with. But the broader one is that there's a saying that every time I ignore it, I get bitten really badly by it, which is the way someone does one thing is the way they do everything. So this is sort of like, everyone knows this from sort of pre-COVID dating world of, if your date is being rude to the waitstaff, sooner or later they're going to be rude to you. If someone is negotiating in a way that you go, oh crap, I wouldn't want to deal with this in the boardroom, walk away immediately, because it's absolutely not going to get any better. I kidded myself really naively to think, oh, well, this is being driven by their lawyer. This isn't, this particular person is being helpful in other circumstances. So, I'll expect her to be helpful, when things move forward, and we're just going to get through this negotiation. 100% wrong. People will always act in the way that they're acting to you right now. It might take until there is a crunch point, but if someone is being difficult to negotiate with and doing a death by 1,000 cuts, they will do that to you afterwards as well. So yeah, it's for a startup, especially when we're cash strapped, part of the reason I didn't see the danger early enough was I was like, great big corporate with flashy name, wonderful, woo-ha, instant credibility, solving all these other problems. No. We are all CEOs, and therefore we are the experts in what our company can and can't do. Yes, lots of people have got other advice, which we should always listen to and then ignore if we don't like it, or we figure out how to test their advice. But ultimately, we all know our businesses better than anybody else ever looking in from the outside. And I forgot that. I allowed myself to go, okay, well, they must know this, and this about this disease indication. No, they didn't. They were just being driven by particular needs. And they're human. And to you, it's, to all of us, it's our life and soul. And we all care about it a ton more than anybody else ever will. And so, yeah, the trust your gut thing is like, you have to do it. And even like looking back now, I wish I'd gone, you know what, I don't have an alternative lined up, but I can't get an alternative unless I ditch this. And looking back now, had that deal gone ahead, it would have already killed our company. We would have just been a dead man walking. And that was only 6 weeks ago. So yeah,
wow.
Trust yourselves, everyone.
Yeah,
Trust yourselves and try and prove or disprove any advice you're given.
It's such a good reminder. Go with your gut. Don't ignore it. Alpita Shah, why don't you come off mute and ask your question?
Hi. So I just wanted to see how we can create an investor funnel to approach. Like, how do you nail down which investors to approach, and any guidelines on those?
My simple one on that, and then there was Lynda to jump in, is basically we did a lot of, so we ended up doing sort of a long rolling close and then a first close. The existing investors did a lot, and our second lead ended up coming from one of our smallest and most helpful investors saying, oh, you should talk to these guys. In COVID, because you haven't got the face-to-face, an existing investor, however small, saying, I like these guys and I've been an investor for a year and I've seen them do X, that is epically more valuable than a cold intro. So look. So my top advice is do a better job than we did of looking after all of your smallest investors and getting any intro you can, because even if they give you an intro that is not a really good fit, and you speak to those people and you say, and you figure out in the first 10 minutes that they're not a great fit, those people then introducing you to someone else is still better than any kind of cold call. So yeah, use your network, even if it's not perfect, and then get into the better deals.
So would you say LinkedIn, or what would be the best way to get the network or form the network?
So start with, I personally start with your cap table, then your employees and who they know. Then, and it is, and here on Startup Health, go through companies that are similar to you and ask them, who were the people that you spoke to that you think we might be a good fit for? we're all here to help each other, and everyone who is on a call like this is willing. And if you can get that down to like a brief, the key thing for asking for help from anyone is make it really short and really easily actionable, so someone can look at your email and in 10 seconds go, oh, they should talk to this person or that person. Like, if you can make it that simple, then you can ask for a lot more help than you probably realize you can. And I definitely start there. And then some of these sort of events like Resi, where you can shotgun your approach with a lot of people, end up with a couple of people who are interesting, and then ask those people, who do you think we're a good fit for? I do have a really strong belief that if you are going to spend an hour of your time with an investor, they owe you honesty on why they're saying no, and if they think they're anybody who might be a better fit than them, that they give it to you. I didn't used to do this, but now I'm pretty brutal. I tell people if they're not going to, and I tell them politely, but I tell them, if you're not going to tell me your specific things that you don't like, and specific things that would be the right milestones in the next round for you to be interested in the next round, then I'm literally not going to talk to you ever again, because you've just wasted an hour of my time. And I do it as politely as I can the first time, but then I get like, no, you're fobbing me off with you're not quite there yet kind of stuff. And the best investors will never do this anyway. The best investors will always give you something useful in their response. But I really think we need to value our time in a way that says, no, I've spent an hour of my time with you, therefore you owe me an honest answer. Because most of the time they're not giving an honest answer, not because, the theory is that they're afraid of offending people, therefore they wouldn't be interested in the next round. I think that answer is frankly BS. It's laziness and lack of time. People are just trying to churn through a lot of numbers, and you're just another bit of noise. So there is no harm at all in saying, no, I really want your honest opinion here, because that's going to help me, and otherwise I've just wasted an hour of my time. And if you do this and you're honest with me, I'll tell the next entrepreneur that I talk to that you gave honest feedback. It's valuable. Does that answer your question?
I think that's
yes, that was great insight. Thank you.
Yeah, and if you check the chat, Alpita, there is, if you haven't looked at it recently, the Startup Health IQ database does track the VC fundings in our space. So you can also look, as Unity said, in the past 12 months and even 6 months, which investments have happened in your category, in your size, break down, which VCs you should be targeting. So it's a good starting point in terms of building your funnel. Lynda, did you want to add something there?
Just a few things to Richard's great points. There's a term, I'll always be raising, and I don't think it's that as a CEO. I think it's always be cultivating, so ABC, in that you're looking for affinity and connection with people throughout your journey. It's not that you're, okay, I'm 6 months out and now I'm gonna look for investors. You're finding people each step of the way that have an alignment and that you start building a relationship with, and then you keep them updated, right? So, whether it's a quarterly report or sharing good news, bring them along on your journey. And then to Richard's point, start in, sort of concentric circles where you've got Startup Health, you've got your cap table, you hopefully have your circle, which is super valuable, and then start building out from there. So often we go wide first and then down, and we start with, we do our practice pitches on who would be on our A list instead of, trying out some B's and C's. So, build those relationships constantly, keep people updated, bring them along in the journey. Be disciplined, which I have work to do on creating that, whether it's an Excel or a CRM, on charting that and understanding, when the relationship started, what they're interested in, and then making sure that as you're building that network, that you're making direct asks of that network for, whether it's introductions or other help that you need.
Thanks, Lynda.
Awesome. Okay, and Natalie has a question about revenue minimums. Either Richard or Lynda or even Barry could chime in on that one, since we see so many term sheets. Natalie, do you want to come off mute and expand on your question?
Yes, I'm just thinking about what is the consensus of what a 4 to 5 year revenue EBITDA financials minimum, which would make a digital health company VC investable, as opposed to not VC investable.
I'll give a very quick answer. Lynda will probably give a much more useful answer. But my quick answer would be that question, as in everything else, will depend very largely on the size and the mechanics of the fund. Because a $500 million fund is going to need to see a certain size for any individual investment, so that their 1 out of 10 pays back their fund. Whereas $20 million fund might have a totally different. I would expect to have a totally different horizon of what matters to them, and so you should. My opinion is that you should be asking that question by average size, by the size of the fund.
Lynda, did you want to chime in on that?
Yeah, I think it depends what type of offering, service, product, SaaS, not SaaS. Like I think it does vary. So in SaaS, there's a model that's roughly used, and there's some good reading. I can share it if anyone's interested. But I think to Richard's point, everybody wants to see the hockey stick, including you. But I think there's two things. Is the be realistic in where you think the next year you're going to be, and then be increasingly optimistic. But you want to kind of ground where you really are and build that trust, because if you're forming a relationship and you're like, oh yeah, we're going to 10x revenue next year, and let's say someone believes that, and then you get in and you can't deliver on it, you've just fractured a lot of trust and relationship value that you've built there. So it depends on what kind of business you are. There is a lot of good investor types of documents of how do you value this type of business, and it's worth reading, right? It's worth getting into their mindset to see what they're looking at. And that's how to qualify too. Like, so often you'll get that associate, that wants an hour of your time, and they're just doing their job. And so your job is to find out right away, like, what are they looking for? Are they looking for 10 million ARR? It's too early. Nice to make a connection, have a 5-minute chat, but move on. So you'll find that like the more you just get into their mindset, and to Richard's point, what they need to return, because their job is to make those returns, the better you can align with what they need. And
related to that, go ahead, Lynda.
Well, I'm just seeing here, small fund, smaller return expected in general. Not necessarily. Yeah, not necessarily. And it depends on, too, how much dilution you're taking, where they're coming in your development.
Yeah, and Barry just said also depends on stage of investment. And in terms of 5-year, a lot of funds that we talk to, they're just looking for even your most recent ARR and what you hit last year, but really they're looking for year-over-year growth. Like Lynda said, they want to see that hockey stick. So I wouldn't say there's an industry standard for a number, because the types of products and business models vary so much. There was a good expert office hours earlier this year with Andrew Isaacs around valuations too. If you were on that one, or if you weren't, there's a post about it on the Health Transformer with some really good tangible tips about how VCs evaluate deals and set valuations. So that's worth checking out along this vein as well. There's something I would love to talk to you about, Lynda, and we briefly touched on this at the end of our call yesterday. Last year, 2019, there was a record broken of the percentage of female founders that got VC funding, and that record was 2.8%. So that's pretty freaking sad. I actually saw an article that said a record was broken, which is like the wrong way to put it. But congratulations to you, Lynda, because you're one of those female founders, and it's a sad reality that it is harder for women to raise venture capital than men. And I would love for you to share anything you learned that you think was particularly helpful as a female. Obviously, you're a phenomenal CEO, regardless of gender. But what was your experience like relative to being a female founder, raising capital, and anything that you could share with your fellow female founders?
Yeah, for sure. I mean, there's definitely a lot of challenges and sexism still out there. I think we have a great set of investors and a wonderful board and just really fantastic people. But back to that point is you're as much of a buyer as a seller, and you're looking for that affinity. That said, it's really, really hard. And, sometimes I just felt like I was in a Pokemon game and I didn't know any of the characters. I didn't have any of the cards. I didn't have any of the power. And I was completely out of my element. And our first two raises that we did, I did on my own. And that was hard and lonely, but also easier because we were earlier on in the company. And, I probably should have learned this after the first time. The second time, I'm like, okay, this is a team sport. And I need to build a great team around me in terms of doing this next round. So I had, one board member in particular who was just phenomenal in finance background. And he had my back the entire time. Really good legal counsel. That just leaned in, answered a lot of my stupid questions. A great partnership with our chief growth officer and bringing him into the mix. So took a very different kind of team approach. And previously I thought, well, I don't want to detract anyone from working on the business, and I'll just tough it out and go it on my own. And I don't think that's the way to do it. And the reason why, and this is what dawned on me, is this might sound really simple, but investing is all about relationships and whether you trust someone or not. And there's that, we still have that lizard part in the back of our brain that is always assessing, that risk trust. Is this someone, is this a safe situation or not? Can I relate to this or not? Is this different or the same? And as much as we try, even the most aware investor is still looking for that common ground. And so when you create a team approach to fundraising, you're broadening the connection, you're broadening the sameness, because you might be the only woman, or you bring another woman into the team, but they'll also diversifying gender, diversifying culture, diversifying background and age, because the more you can see that, the more you're going to connect and form those trusted relationships. So that was a really key learning point. And it's human nature, right? We're all looking to de-risk any situation. It's survival. And we don't realize our brains are doing it, but they are. And so the more I think you can just come to terms with that, and then through your success as a female founder, start changing things, then away we go. But it's easier to change things from a position of strength. So that was my approach.
That's so true. Go ahead, Richard.
Because we're going after fibromyalgia, I've spoken to come a lot of people VCs who focus on companies that deal with women's health, and there are a couple of those that we specifically did not get the investment from because of my gender. So on the flip side of the coin, if you find yourself in that position, absolutely make sure you know exactly who any potential investors are in your area who focus on women founders. And because you'll find that there are a chunk that actually have mandates that they're not allowed to invest not on women founders. And even outside of that, if you've had an experience of it being tough, which I presume all of you have based on some of the things Lynda said, I just target the women VCs, and because they will have experienced other people who've experienced your position, and more importantly, they will know the value that you have gained in terms of your own knowledge and ability because of having those difficulties. And I'm saying this as a disabled person. We get this benefit. People kind of assume that, oh, life is really hard for a disabled person, and therefore you must have a degree of competence above the average, unless they're going to dismiss you out of hand. So either way, don't necessarily assume it works against you, but look for the ways that it could help you.
Great. And, along this same topic, we talked yesterday, both Lynda and Richard, you talked about the people that you wrapped around you as the team and to help you with your raise. And a couple things that, and Richard, maybe you can comment, it's complementary to what Lynda said, but, having people who have done a lot of deals at the table, on your side of the table. Can you talk about that and what that brought to the table? I said table a lot, but go for it.
Yeah, certainly. So we've had helpful board members and people who are around, but then more recently I've had one guy who has done a very large number of biotech deals and been an operator, and now we're gonna pay him a not insubstantial amount of shares to be an independent board, a board member that's representing the common stock. And oh my God, is he adding way more value than the percentage of shares that we're giving him, even though that looks large from a market percentage. So it's really important to have someone on your side who's done a lot of deals, who is prepared to spend time with you, advising you. That there's just no substitute for that. And it doesn't necessarily need to be someone in your particular area. It just needs someone who's done a lot of health deals overall. Have that person in the people that you can call in any point of negotiations, because it really, really matters. We had that in our lawyers to a certain degree as well, but you need this in someone who's not on the clock every time you call them.
Yeah, totally agree. We've found that a lot in our fundraising at Startup Health. First of all, we've got Barry crying full time, so we're lucky there. But also have had folks advising us who, when people see so many deals and that's their bread and butter, there's this pattern recognition, and they can really help you identify flags, at every step of the way. Lynda, do you have anything to add on that topic?
Yeah, I would just say, if you can, having a good relationship with your board or your advisor group, if you don't have a board yet, is really important. And that board can be, for me, one particular individual who's got a finance background has been through a ton of this, because the board they can, in a way, not be the bad cop, but they can, they know you, they know the business, they can reflect back maybe some things that you're not seeing or some blind spots. So, bring them into your team, or bring that person on your board or advisory group that's got that finance background, has been through it, and can help you avoid some big mistakes.
Startup Health invests in health transformers from around the world who are committed to achieving audacious health moonshots. If you want to learn how you can join this community of entrepreneurs, or if you want to connect with one of our 330 companies, go to startuphealth.com. Thanks for listening to Startup Health Now. We'll be back next week.